So I think that there is a shift in the fourth quarter relative to the first three quarters of the year, not just the fact that the earnings growth rate will be quite a bit lower than it was in the first three quarters of the year. But to your point about the typical tendency of analysts to maybe be too optimistic at the outset, then lower numbers too much, and then you get that significant beat. But it's looking a little bit different in the fourth quarter. We are actually seeing that deceleration. And more importantly, from a market perspective, are the expectations heading into 2019. With Q1 now, consensus Refinitiv estimates down only 1.8%, which puts that below the rate of inflation, which means if we're around that number, you're talking about a negative real earnings growth rate. So I think the commentary around earnings this time for the fourth quarter is more important than the actual numbers. I think from a market perspective, the percentages that matter are the growth rates looking into 2019.
And when you do your own analysis, are you looking at our economy per se? I know I'm leading the question here, but are you looking at our own economy or the economy overseas, especially with China?
All of it. In fact, part of the reason why you've seen such a dramatic fall off in estimates for 2019 since October, when they first started getting published for 2019, is that there was sort of a three-step process in analysts adjusting expected growth rates. They were very late in the game in making the adjustment to the energy and energy-related sectors for what had been the collapse in oil prices last year. Secondarily, they made a quick adjustment for those companies exposed to China when we were in the heart of the trade war. That was the natural place to cut. Then only more recently have cuts come tied to Europe, which is a bigger impact on both top line and bottom line for the S&P 500. Every day you see a ratcheting down still of estimates, right. And I do think that there is a risk, even if an economic recession is still less of a possibility in 2019. I think at least in the first half of the year, there's some chance that we could get an earnings recession.
All right, so earnings expectations might be ratcheted down. Consumer confidence isn't looking too great either, Liz Ann. I know you tweeted about that today, the fact that we're at 42, which is below a key recessionary level of 43, the third straight a drop. What do you make of just sort of the state that we're operating, at least in the first half? I mean, I know many investors out there are longer-term investors, but in terms of girding for volatility, it seems like there are a lot of potential landmines in the first half of the year as analysts start getting to more realistic expectations, and the consumer is dealing with a lot of the uncertainties in the economy.
Well, our view is that volatility is going to persist this year, and that 2018 was sort of a sign of what is to come versus 2017, which was actually the exception, not the rule, from a volatility perspective. So I think when we think about the earnings progress for 2019 and the fact that you still got double-digit expectations for the fourth quarter, that probably still has to be ratcheted down. But I'm going to put maybe a slightly more optimistic potential twist on things as it relates to valuation on those earnings. We know 2018 was a strong earnings year, but we saw valuation compression, not just because the market looks ahead at what were diminished growth expectations in 2019, but also we had strength in the dollar and tightening financial conditions, both which historically tend to put downward pressure on multiples. The interesting thing that could happen this year is, even in the face of more negative earnings news and possibly a move into negative territory, if we see a continued loosening in financial conditions and you see a continued weakening in the dollar, that might take some of that downward valuation pressure off, and we don't have that as much to worry about as we did in 2018.